Hello traders, Gary Wagner for Trending Markets just before 11 o'clock in Honolulu, 5 o'clock in New York. It is Monday, 24th day of August 2015. Tremendous sell-off in the equities markets, a continuation from the carnage that we saw beginning on Thursday of last week. We saw this market decline almost 4% on the day. Dow Jones Industrial Average down 588 points to close at 15,871 and change. A tremendous sell-off in the marketplace. When you look at the kind of action that we have seen, you can see that it has exceeded really any of the former corrections that we have seen in this market, unless we go back to 2008, 2009, in which we saw the market sell off from 16,000 down below 1,000 to about 700 on the S&Ps. And traders, picking up from the gold forecast, of course, which we just recorded, we did take a look at a couple of charts. We looked at gold and the S&Ps in terms of how they traded through 2008, 2009. But I'm bringing this chart up just to show you the kind of devastation we saw back then, because I believe that what we're witnessing here is not a homegrown correction. In other words, this started overseas, and I believe that our economy is a little bit better than many are perceiving it to be. Now, where will this market stall or stop? Where can we find some sort of support? Well, you have to look at 1,800 here on the S&Ps, because that's the most recent bottom that we can look at in terms of a technical point for this market to stall. But most importantly, we talked about the fact last week that once we broke through this 200-day moving average, and I've just brought up a daily chart. This is the E-mini S&P with the 200-day moving average. But once we broke through this point, we determined that it would really be off to the races, and you can see genuinely over the last 3 trading days the kind of carnage we have seen. Now, this market hit a low at roughly 1830, call it roughly in that area, but as you saw from that last chart, it's not till about 1800 that we have any kind of support in the marketplace itself. Of course, one of the primary things that we looked at also were the currencies. Absolute craziness in terms of the currencies. The US dollar off almost 1.75%, actually off 1.75% at 93.35, and the other really active currency when we look at it is the Japanese yen. Japanese yen off almost 3% on the day at 118.40. That just plunged out of bed. In fact, looks very much like the S&P chart when we consider just the raw data and the size of this move. Now, we're not in the dollar and we're not in the S&P, but we are in crude oil, and crude oil actually fared pretty well in our favor. We went short, of course, at 41.87. Market's down about $2.50, almost 6% on the day, breaking through 39, hitting 38, currently trading at 38.04. Of course, we are going to trail our stops down today. I will send out a special trade alert, but here's what we're looking at, and this is that weekly chart that's really been providing us with a lot of quality data. And we have to go back in terms of the last time this market has been at this point. And once again, we go back to that 2008, 2009 period, because that's when we saw this market drop precipitously like a rock and then begin to climb back up. You can see that beginning of 2009 is when the market climbs back up, but through 2008, we saw this market barreling down, and we have these lows here. These lows are sitting at around 31.32. So in terms of historical data and historical precedents, we do have the ability on a technical basis to see this market travel below. Now, the numbers that we were looking at were 37.38. That was my initial target. I also believe that there's a potential for it to move lower, and we really have to see a shift in the fundamentals before we're going to see this market really find some sort of tentative bottom and begin to move up. And what I mean by that is this is a basic supply and demand scenario unlike most that I've seen. When we consider the sell-off in the S&Ps, let me ask you something, traders. Did we see a tremendous fundamental shift in the U.S. economy between Wednesday of last week and today? And the answer has to be really no. We had good housing starts. We didn't have data that supported that tremendous sell-off we saw in the equities markets. In terms of oil itself, that is really a fundamentally driven scenario, whereas what we saw in the equities markets was not so much a speculative, but a knee-jerk reaction to turmoil overseas. And the speculation is whether or not that turmoil in China will carry over into Europe and carry over into the United States. And money is being bet on the fact that it will. But once again, it's not really a supply-demand scenario like we're looking at in crude oil. And based upon these lows here that we saw in 2009, could we see the market move back and test these lows again? They certainly could. We're going into the end of August, and typically September, October, November has the least utilization of oil, at least in the United States. Summer driving is over, not using any heating oil because winter hasn't really come in. We're looking at autumn, and so therefore you have the demand decreasing over the next couple of months, and that's all being factored into the market. My recommendation is to maintain our current short position in crude oil, maintain the stop until we send out a trade alert later on today, and that trade alert will give you new numbers as to where to move that stop down to. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.